Today's session we're going to look at earnings per share. Earnings per share is simply dividing the earnings that a company has made in a period divided by the number of shares. So you need to memorize the formula. The formula is given as EPS equals earnings divided by the weighted average number of equity shares outstanding during the period, and the answer is given in cents. Remember that always your answer is given in cents. The earnings are described as the profits or loss for the period attributable to ordinary shareholders or to owners of the parent in a case of a consolidated company, which will be the consolidated profit after income taxes, non-controlling interests, and preference dividends. The EPS is only required to be disclosed by those entities whose shares are publicly traded on the stock exchange. So what happens is that when new shares are issued, these will result into a change in the equity share capital of the current shareholders. Now there are three ways in which shares may be issued. The first one, the shares may be issued at full market price. When the shares are issued at full market price, this will increase the earnings. Therefore, we use the weighted average number of shares to compute the EPS, but we do not restate the previous year's EPS, so there's no retrospective effect to the previous year's EPS. The second way that shares may be issued is through a bonus issue. A bonus issue is where shares are issued to the current shareholders at no consideration. So basically the shares are given, so to say, for free. So there's no additional cash coming into the business from the shareholders. So this will have no effect on earnings. Therefore, apply retrospectively. Also, you restate the comparative EPS for the previous year. The third way shares may be issued is through a rights issue. A rights issue is when new shares are issued to offered rather, because they have to accept to the offer or not. When new shares are offered to the current shareholders at a discount. So a rights issue will result into some effect on earnings. Therefore, you should treat as an issue at full market price, followed by a bonus issue. So these are the three ways in which shares may be issued, and this is where the questions will be drawn from. So understand very well how the computations will be done and the effect on the EPS. So when you get a question, you have to establish whether is testing you on a full market issue or a bonus issue or a rights issue. So go into this now in details. We'll start with the issue at full market price. So where an issue of shares is made at full market price, the company ought to generate additional profits because there are extra funds which are being invested into the business. However, there is an issue which has to be addressed. If the issue of these new shares was not at the beginning of the year, then this will need to be time apportioned to reflect the fact that the company will have only been able to generate extra profits from these extra funds for part of the year. So, for example, if a company has earnings of 100,000 and it has a year end of 31st December, it decides to issue new shares on 1st October 20x2. Let's assume they issue 300,000 shares at full market price. And before they issue, the shares in issue were 600,000 shares. So since our year end is December, it means the beginning of the year will be 1st January. So we'll count from 1st January up to the date when the new shares were issued. So we've got 9 months. So from 1st January, we've got 9 months. So those shares, the 600 shares which were there from 1st January, you have time apportion them. 600,000 times 9 divided by 12 to give you 450. And then from 1st October, there was a full rights issue of 300,000 shares. So from 1st October to December, we now have in issue 900,000 shares. These 900,000 were in issue for 3 months before December. So 900,000 times 3 divided by 12 gives you 225. So the weighted average number of shares in the year was 450 plus 225 to give you a total of 675,000 shares. So you can now compute your EPS. The earnings, 100,000 divided by the shares, the weighted average number of shares, 675, to give you an EPS of 14.8 cents. We move to a bonus issue. We've already explained what a bonus issue is, so we'll move straight into the illustration. So in this example, a company has a 1-to-1 bonus issue on 1st January X2, meaning if you had 1 share, you are given 1 more share, so you now have 2. So your bonus fraction will therefore be 2/1. Most students, they struggle with this 1 for 2, 1 for 3. Please try and understand it. It may not come in EPS, it may come in consolidation when you are paying your consideration for shares through a share issue. You're going to meet this 1 for something, so please understand it well. So in this case, we've got 1 for 1. It means your bonus fraction will be 2 divided by 1. So we have the assets there are not changing, 100,000 from 20x1 to 20x2. There's no extra income which has come, no extra cash which has come. So you expect those assets to generate the same earnings of 20,000 in 20x2 as it did in 20x1. But you notice that the number of shares has increased because of the bonus issue. In 20x1 we had 100,000 shares, we now have 200,000 shares in 20x2. So when you compute your EPS for 20x1, you get 20 cents. For 20x2, you get 10 cents. Now EPS is used as a performance measure to assess how a company has performed from one year to another year. But as you should be aware, when comparing performance, you need like with like. The fact that there are more shares in 20x2, then we're not comparing like with like. So that EPS of 10 cents in 20x2 cannot be compared with the one in 20x1. For us to do that, to be able to compare the two EPSs, we need to restate the 20x1 figure as if it had the same share capital as 20x2. To do that, we multiply the earnings divided by the number of shares, which we also multiply by the bonus fraction of 2/1. Or we could simply get the EPS for 20x1 and use a reciprocal of the bonus fraction. The reciprocal simply meaning, since the bonus fraction is 1 over 2/1, the reciprocal is going to be 1/2 times the 20 cents to give us 10 cents. Then we can compare 20x1 and 20x2 EPS.